I was at the gym and a friend told me that they weren't going to buy a house simply because they thought it was not a good time to buy a house. And what stood out to me the most wasn't the fact that he couldn't afford a house. It wasn't that he wasn't ready financially. It was how confident he was that buying a house right now was just a bad idea. So I asked him, why do you think that? And he told me that he is waiting for home prices to tank. And honestly, I don't blame him for thinking that way. A lot of people who've never bought a home think the exact same way. Most of the time, that personal belief doesn't derive from personal experience. That type of stuff comes from social media and what people hear off of the internet. So instead of arguing with him and trying to convince him on the spot, I asked him one simple thing. How much do you pay in rent and how big is the place? And based off his answers, that's what sparked this whole entire video. Because when you really boil down to it, the answer is pretty simple. What's actually better, paying $1,500 in rent or paying $1,500 towards a mortgage? So in today's video, we're going to be talking about the main difference between buying or renting a house for $1,500. After spending around 15 minutes on Zillow, I found a few good rentals for around $1,500 in rent. And usually what you're going to be getting around that price point is 1 to 3 bedrooms, 1 to 2 bathrooms, and roughly around 1,200 square feet. Then I went ahead and asked myself, okay, now how does that compare to buying a house? And this is the part that people really don't understand. So when you are finding a rental house, that payment that you find, it's really easy. You can just look it up, look at the house and see whatever it's listed for. When you're trying to find what a mortgage payment is, that is completely different because you don't start with the payment up front. So what ends up happening is that you need to start with the actual house. First, you need to find the estimate of the price of the house. Then you have to find the estimate property taxes. And then you have to also estimate the insurance. For a $1,500 payment, you could probably find a house for $170,000. Now, the numbers I ended up calculating is using an FHA loan with a 30-year fixed rate, 3.5% down. To qualify for a house for around $170,000 without any debts, you're going to need to make around $35,000 per year. Now, if we go ahead and include the down payments and also closing costs for the loan, total out-of-pocket cost to buy looks to be around $15,000. That breaks down to roughly $6,000 for the down payments and then another $9,000 for closing costs. Now, finding a really nice home for $170,000 comparatively, it's not going to be that easy, especially if you want to be right downtown in your city. If being downtown in your city is not number one on your list, then you can still go ahead and find a house in that price range. Nothing crazy, nothing brand new, but still very livable. Now, decent homes around $170,000 are roughly going to be the same size for what you would find for in renting. And on top of that, you're going to be able to find the same 1 to 3 bedrooms, 1 to 2 bathrooms, 9 to 1,200 square feet for the house. From a simple standpoint, you're not going to be sacrificing anything. It's not like you're going from a mansion to a shoebox. Now let's talk about the part where most people oversimplify. When you rent a place, usually the few things that you have to do up front is you need to fill out an application, you need to pay for that application fee, which is around $50. Then you have to check your credits, show your proof of income, and then if you are actually selected to move in, you have to go ahead and spend that first month's rent and also security deposit equal to 1 month. So on a $1,500 rental, you're looking at about $3,000 just to get the keys into the house. And then every single night you live there, your money is just gone. You don't get it back in any meaningful way. Now, let's compare that to buying. Yes, buying costs more upfront, but here's the difference that most people don't think about. Not all of that $15,000 disappears. From the example quote we just did, $9,000 of that goes towards the closing cost of taking out a loan, and then $6,000 goes straight into the value of the house. You need to quite literally consider the down payment as walking down to your bank and depositing that money into your bank account. The only real money that you're technically losing is coming from the closing costs. However, if you are in a buyer's market like we are right now, sellers are often helping to pay some, if not most, of the closing costs to buy the house. There are instances where buyers are really just bringing down the down payments, and I have deals to back that up. Now back to renting. What happens after you move in? You're locked into a lease for about a year. Then at the end of the year, you can either renew or you move. If you renew, there's a good chance that your rent is going to go up. And historically, that's around 3 to 5% every year. Now, if you go ahead and move, you need to pack, you need to move, you need to take time off of work, or you have to line it up perfectly for the weekend, so you lose a weekend or two. And then on top of that, you have to put down another deposit. And that's assuming you get your old deposit back, which doesn't always happen. So renting kind of like resets every year if you don't renew the lease. Now, buying works different. There's no lease, there's no landlord, and there's no time limit on how long you can stay in the house. All you really need to do is negotiate once when you buy, and if you want to go ahead and improve your living conditions, you can do it. You can spend money fixing up your own home without asking anybody for permission because you are the landlord. Now, let's not ignore what is actually happening to a rental if you are staying there too long. Let's be real for a second. Do you really think year after year your landlord is going to make your rental better? Or do you think your landlord is going to do a renovation the instant you move out? Now let's go ahead and talk about the long term, because this is where the real difference shows up. Here's how I did the math. When you buy a house, your principal and your interest payment stays the same. That's a non-negotiable if you do a 30-year fixed rate mortgage. Now, what does change are your property taxes, insurance, and also potential maintenance that you do on the house. So in my numbers, I increased all three every single year based off of the value of the house. And to keep it conservative, I assume that the house only appreciates for around 5% every year. And for maintenance, I kept that simple. I set it at a flat 1% of the new home value every year. Now, if we go ahead and look at renting, just to keep it as a conservative estimate, I also put the rent increasing by 3%. And when you go ahead and compare the two over time, the total cash out of pocket that you spend is actually pretty close. After about 10 years, the renter is going to pay well over $200,000 in rent. And unfortunately, that money is just gone. Over that same 10-year time period, the homeowner is going to have to pay around similar amount in terms of total cash. But here's the key difference. Every single time the house payment is made, you're depositing money in the bank. Now, between the home appreciating in value and also paying down the loan, the homeowner is going to be sitting on around 6 figures of equity, and the renter isn't. And let's be honest for a second. If you're renting the same house for 10 years, do you really think your landlord is going to be renovating it? Trick question, no. So you're going to be living in a worse house on a year-by-year basis, and then on top of that, your rent is an increase? No thank you. And unfortunately, that's just the reality. Although when you own your own house, you can live in your house year by year, and if you want to go ahead and spend money to renovate it, you're not lighting your money on fire. You're actually adding value to your own home. Now let's talk about the stock market argument, because this one always comes up. People say, why not just invest the money into the stock market? So I went ahead and ran the numbers for you. Let's say instead of paying $15,000, you rent it out for $3,000, and then you get those $12,000 and you put that into the SP 500. Now, assuming at a 10% annual return and you reinvest the dividends, after about 20 years, those $12,000 are going to turn into something like $80,000 to $90,000. Sure, that sounds good on paper, but here's what most people miss. When you invest $12,000 into the stock market, those $12,000 are only growing on $12,000. It's 1-to-1. Then to add fuel to the fire, every month that goes by, you need to control your temptation to not use that money at all. When you have a house, that money is locked up into the house and it's harder to use. When you go and buy a home with a small down payment, you're controlling the entire value of the house. So even if the home only appreciates for around 5% every year, that appreciation applies to the full value of the property. It doesn't mean housing magically beats stocks. It just means that the math works differently. And that is why over a long period of time, homeowners usually end up with a higher net worth. And one more thing that people usually skip over are taxes. When you rent, that's it. You don't get a tax break just for paying rent. When you own a house, you actually have opportunities to reduce what you are paying in taxes, like mortgage interest and property taxes. Now, does that alone make buying worth it? No. However, renters don't get that option at all. So what's the main takeaway here? This video isn't saying renting is bad. Renting makes sense if you're moving soon or you just need more flexibility. But the idea that buying a home is a bad financial decision once you include all the costs doesn't hold up when you actually look at the math. The real question isn't, is now the perfect time to buy? It's, what is waiting actually costing me over time? And if you want help running these numbers for your situation, your income, your credit, your timeline, that's exactly what I do as a mortgage broker. Thank you for watching today's video. If you're interested in reaching out to me, my contact information is going to be in the comment and or descriptions. And other than that, have a great rest of your day.